Chris Conway is from the Australian Stock Report. He is live from our Melbourne studio for you this hour. Let's go across town there to you. Chris, welcome into the show. Big questions being asked about the 6,000 level, although perversely energy looks to be in a sweet spot if you put today to one side, with the M&A fervour arguably doing a lot to reverse the fortunes of some of those plays in terms of the sentiment play. Is that going to be a catalyst for 6,000, rebound in energy, or there's more at stake?
Yeah, look, I think commodities will be a big factor on whether we get to 6,000. Look, that number is largely immaterial, though I've said that for a while now. The real concern for investors should be whether the market can punch up to 6,200 or even 6,400, i.e. where the next big move is coming from. And commodity or consistent commodity price strength is definitely one thing that would help us get there. Of course, the other being another RBA cut, but of course they didn't do that on Tuesday. So, yeah, commodities will definitely feed into it. We're not particularly convinced that commodities can move consistently higher, though. You look at the supply-demand dynamics in both iron ore and oil, and they don't look particularly great from where we sit.
Well, let's talk some of these deals we're hearing about today. We've obviously been talking about them all morning. Apache, for one, selling these assets to Macquarie and Brookfield Asset Management. Also, of course, we're digesting that Shell and BG deal as well. How does that play out, in your view, for the Australian energy space?
Look, I think it brings local companies into focus in terms of being taken over, but the problem we see is that Australian producers' costs are simply too high. That's, of course, why we've seen Chevron and Apache exit recently. There's just not enough margin there. So whilst these companies will come into play, again, you know, the people that are looking at them have got to think, will there be value in the deal? And from where we sit, we think that's questionable. Santos is probably the one that is most prominent. They do have a good stake in a quality LNG project in Papua New Guinea. They also have their Gladstone project coming online in the next 6 months. And, of course, the share price has been absolutely hammered since August, down around 50%. So that's probably the one that we see being in play. But, again, it comes down to the costs. Costs are just so high for Australian producers comparatively to overseas producers.
And some analysts saying that the marriage of Shell and BG could actually make life quite a bit harder for Santos because of its short of gas at its Gladstone LNG facility. So, you know, does that play out in a negative sense, that deal, that Shell-BG deal for Santos?
It very well could. Yeah, most definitely. Look, again, it all comes down to cost. So if the Shell-BG deal allows them to produce at a significantly lower cost, then it prices Santos out of the market to some extent. So, yeah, it could be a negative, most definitely.
How do you position for that in terms of an investment thesis? What's your advice to clients?
We certainly wouldn't be buying any oil plays now. Look, what you're relying on there is a takeover. And look, it may happen, but, you know, in terms of an investment proposition, it's not a particularly strong one. Longer term, as consolidation does come into the sector, then, yeah, you would start to look at oil plays more closely, but we certainly wouldn't be owners of any oil plays at the moment.
All right, what about iron ore then? How do you look at this space at the moment? We've obviously seen the iron ore price slightly rebound now for the last couple of sessions, but certainly those iron ore plays aren't in favour still today, all in negative territory. Are they starting to get cheap in your view? Are you looking at sort of, as some people say, catching a falling knife?
Yeah, I would think catching a falling knife. The big story there is production. We all know that BHP and Rio Tinto continue to bring new production online. We've seen that Gina Reinhardt is bringing her Roy Hill mine online, and that's going to add another 55 million tonnes per annum. So you know, it's the old supply and demand equation. There's simply too much supply, not enough demand. That means prices will likely head lower. Where's the floor? That's the big question. So BHP and Rio Tinto, they produce at around $30 a tonne. Realistically, we couldn't see the price moving too close to that. Probably $35 to $40 a tonne is realistic. But if that iron ore price keeps falling, then those names will continue to get cheaper.
All right, Chris, we might leave it there for the time being. Thank you so much for joining us.
Thank you very much.
Chris Conway there from Stock Report.